to a community bank. So, have it.
So I'm Catherine Zinzer with Bank of San Francisco. I've been a commercial lender for over 30 years doing a variety of different kinds of jobs at competitive banks. I've been with Bank of San Francisco for 5 years. We are only a 7-year-old company, so we are a startup ourselves in a sense, and we are dedicated and we're set up to service the small business and medium-sized business market in the close-in Bay Area. I would say we have a very conventional, very old-fashioned business model. I was trained as a conventional lender working with large companies. Our business model is, I would be your first point of contact. I would work with you to see if you could be a good fit for what we do well. I would structure the loan with you. I would then present it at credit committee and be heavily involved in the loan underwriting. Then I would oversee the documentation process, and then you're stuck with me on your bank. So I would not be moving you around from one part of the bank to the other. Also, our product range is pretty broad. I was trained as a conventional banker, so I can do regular lines of credit, term loans, conventional real estate. But then we also are an SBA preferred lender, which means that we can do their cap line program, which we're just getting into. We can do their SBA 7A and Express program as well. And of course, we can do the 504 program, which is for purchasing real estate. Another program that we were given an award for generating the largest volume in Northern California is a program with the state of California that provides loan guarantees similar to what SBA does, a different profile, a different process, at times more flexible, at times less flexible. It's not your job to figure out, I think, as a small business person, what's the best product for you to buy. It's more to communicate what do you need, and then I'll figure out whether you should have the blue sweater or the red sweater, how to customize this for you at my bank. But all of these product types we have found have been incredibly important and helpful to small businesses. Our typical client is not a startup, though I've done a few. Generally, they have credit needs between $250,000 and $5 million. So that's part of the negative of working for a tiny little bank. We have very constrained resources. There are only 4 commercial lenders. Soon to be a 5th one is joining my team. And so we can't handle the microloan programs and needs that you have. There are other lenders at this conference that can do that. And then we can do term loans. Generally, they're 3 to 10 years in maturity. Generally, our loans are based on the prime rate, which is currently 3.25, plus some kind of a spread that would come into it. Many of our loans to small business require that you have life insurance that is assigned to the bank. That means key man insurance. Should something happen to you and you're very important to the company, you should consider having life insurance that could pay off the debts of the company. Often we are working on business acquisition loans. We do those generally on an SBA basis, but I've also done them with the state guarantee program in a smaller amount. And those do require that you put some cash down, usually 10 to 20%. So if some of you are thinking of trying to get into business by buying another business, that's a very viable route to go if you can find the right candidate. We also generally ask our clients to guarantee, the owner to guarantee the debt, which is not always a popular request, but that means you're signing on the loan. Even if you don't have a lot of assets, we want you to stand by that loan so that should there be a problem, you'll work with us in trying to get the deal repaid. Lines of credit, again, traditional or through some of the guaranteed products with the state and with SBA. Our typical client is profitable and headquartered in the close-in Bay Area. I have clients in the distribution, service, manufacturing, and retail industries. And if you take a look at the Bank of San Francisco website, you will see two of my clients featured that I'm very fond of and very pleased with. One of them is the Little Chihuahua Restaurant. I don't know if any of you have ever eaten there. They have a restaurant on Visadero, and they just opened a new one in the Mission. They have another one in Nov2012 Valley. They're kind of alternative, upscale Mexican fast food, and we've helped them finance some additional add-on locations. And then another one that's featured on our website is EO Products. And in particular, the women here, some of you may have bought their lavender scented hand soap, their shampoo, their hand lotion at Whole Foods or Bath and Beyond. That's a woman-owned business and extremely successful, and we've helped them numerously with expansion programs. We would also, though we can't require it legally, we would expect that we would bank you as your primary bank. So when you need a loan advance, it goes into your checking account at the Bank of San Francisco. And we would also work with you on a merchant account if you need that. If you want to bank with us personally, we welcome that, though it's certainly not required. So it's very much an old-fashioned banking model. We are your community banker. We are a strong community bank. We've had very little bad loans experience, but we can be picky. So I can sit down based on my experience, talk with you for a few minutes, and probably put an initial screen if you and I should put more time into pursuing a relationship, because I've been there approving loans. Catherine Sinser, Bank of San Francisco. I look forward to meeting more of you after the session to see if I can be of help.
Catherine, thank you very much. Very, very well said. You know, most of us have our family doctor, right? Most of us have maybe a family attorney. You know, I have a guy for everything that breaks down in my house. You know, if the plumbing goes, I have a guy. You know, if I need to buy a house, I have a guy, you know. Very few times do we think of adding a banker to our team, especially when you have a small business. You know, we sometimes forget that. You know, we forget to have a team. You know, we think about us personally, you know, especially if we have a family, you know, you have certain things in place in case things go wrong, whether it's your health, whether it's your finances, whether it's to buy a home or life insurance or whatever it may be, you have someone there. Very few times do we think about having a relationship with the banker. And whether it's a community bank like community banks in San Francisco, or whether it's Chase or Wells or most other banks out there, I think one of the lessons we've learned, and I keep saying we because I wasn't Wells for over 7 years, so I apologize. But you know, I think one of the lessons we've learned throughout this down economy is that we need to take a step back and go back to the old school way of doing things, when it was all about relationships. So we as lenders, I think, are doing trying to do a much better job of doing that. But you as small business owners should also consider that as a very important part of your team. Okay, very, very important. So thank you for that, Catherine. Thank you very much. So you've heard from 3 different banks, and you heard a lot of the bank perspective. I'm gonna turn it over to Lynn Fernandez, who's our VP of Lending for VEDC, and give us some perspective, not necessarily specifically to VEDC, but as a non-bank community-based lender, how do we view deals? What's the advantages? What type of transactions do we see? Lynn.
Okay. So, as I previously said, we are an alternative lender. So the types of credits that we look at are going to be, can you hear me? Okay.
Thank you.
So, as a VEDC, we look at both existing businesses and startup businesses. What we'll see, if you have the existing businesses, usually they will not qualify for bank financing because of certain reasons. The majority of the time is because of the previous 2 years of income. 2009, 2010 for existing businesses was pretty tough. A lot of the businesses we've been seeing have had negative profits. 2011, they're starting to turn around. 2012, it's starting to look better. However, when they go to the bank to try and get the financing, the bank is unable to do it because, as previously said, the banks do look at the historical profitability of the company. That's where we will come in to try and help out the business to provide the financing. because we understand, what's happened there, and we will base our analysis on projections too, as long as they are supported projections. So we're able to come in and help out those small businesses who have been in existence. With the startup businesses, you have, banks will look at startup businesses unless it's the SBA. Startup, as definition of startup is 2 years. So we will look at startup businesses and take that into consideration along with their credit and collateral. As long as you have the collateral and you have your business plan for your startup businesses and your credit is pretty good, we can step in and help out the client. Other scenarios that we've seen is credit. The business has good cash flow, there's the collateral, however, the credit of the individual has been affected, and that could have been affected because of modification, home loan modification. We understand that in order to modify your home loan, that you had to have a default on your mortgage, okay? So that turns around and affects your credit. We understand that also, so we'll take that into consideration and look at that to see, is that what has happened? And we'll proceed with moving forward with a loan request for the business. I just wanted to kind of back up and just say, my experience, I've been in banking for over 20 years, so I've been on the direct lending side, and I've seen it where, I've tried to help out the businesses, I just cannot help out the businesses because the business itself does not hit the qualifications that are required by the banks. The banks are required to have certain qualifications. The regulators, they have certain qualifications that they have to meet, and if they do not meet those qualifications, then the bank is unable to do it. So I've always, wanted to help out these small businesses and did not know what to do. I was the one who was turning them away, saying, sorry, I cannot help you out. And then I heard of VEDC. There's other alternative lenders out there also like us, and that helped me out. I was able to help out my businesses, help out my clients, provide to them the financing that they need, continue to maintain the relationship. So now being on this side, I enjoy being able to help out the businesses, maintaining the relationships with the banks because the banks are providing these referrals to us because the banks are unable to do it. Our ultimate goal is to get the client bankable. We want to see the client become bankable and transfer that relationship back to the bank. One of the big key things with our credits is we have no prepayment penalties associated with our credits. This way, when you do get to that point, you are bankable, you're able to be transferred over to the bank and become the conventional borrower. Our credits themselves, our credits themselves are between $50,000 up to $500,000. We have, our rates are a little higher, but that's because they are a little more riskier credits that we are looking at. And we have, our credits are not lines of credit. We do provide the term loans. So on average, we're between 3 and 5 years for the credits that we provide to the clients. But previously stated, our goal is to be able to help out the small businesses, to help out the individuals who have this dream to start their business. And if the banks are unable to help you, come to us so that we can see if we can help you. Just always keep in mind the 3 C's that we look at: credit, collateral, cash flow. If one of those 3 things are missing, come to us so we can help you out. If 2 of those 3 things are missing, still come to us so that we can come up with a solution. Our ultimate goal is to be able to help you out one way or another, whether it's saying, I cannot help you out because I need additional collateral. Here's examples of collateral that we're looking at. But one of the things here in the Bay Area, we're very proud to say, we've been able to help out businesses here in this area. We have loaned out a little over $3 million to businesses here. We do have an individual who's speaking today on one of our panels, Sweet Bar. So we were able to provide financing to that business. It's a bakery. So we do provide financing to restaurants, manufacturers, the service industry. Our industries that we service all across the board. The only ones that we will not provide financing for are for real estate investment entities, home mortgages, or the adult entertainment industry. So we do try and stay away from that industry, especially in the Valley. All right, I guess that's it. I see Tony starting to stand up.
Well, according to California voters, I think the industry is moving out of California, or at least Southern California. Anyway, right, maybe moving up here. Hey.
It's a new business here.
First you take on water, now you take on anyway, thank you very much, Lynn. Again, a lot of valuable information as a non-bank community-based lender provides not only VEDC, but we have a lot of partners out there that do what we do, you know, most of which quite at a smaller scale, whether it's micro loans or whatever it may be. But the real advantage as a small organization, we have the ability and the flexibility, similar to that of Catholics, for example, where you deal with Lynn or myself or one of our staff people, you're probably going to deal with that same person throughout the process. And that same person is probably going to be the one taking that to a loan committee of 4 or 5 people to fight for your loan. And that's why I said it's really important to have a banker or a loan officer as part of your team. If they understand you, your business, and believe in it, that oftentimes takes that deal from being kind of in the gray, I don't know area, to, hey, you know what? I've met these guys for the past 45 days, I believe in them, they're there, let's do it. So it makes a big, big, big difference. Non-bank community lenders play a huge, huge role, especially in today's economy, simply because the banks can't do it all. And we are a partner to them. We're not in competition with them. As Lynn mentioned, we are the bridge. We try and be that bridge from non-bankable, quote unquote, folks, and hopefully graduate them, quote unquote, to be bankable. Actually, for most of the loan programs, it's a requirement for us to ask you, have you gone to your bank first? Some of our loan programs even ask for a decline letter first. We want to make sure you try to get credit elsewhere. Because more than likely, our loans may be a little more expensive. Not much. If a bank's at 5 or 6, we're probably at 6 or 7%. Not by much, but we got to offset that little extra level of risk. So very important. Thank you very much. So far you've heard from, 2 large banks, a community bank, and an alternative lender, all of which look at you in terms of trying to qualify you for that credit. We're going to hear from Andrew now, who's going to talk to you about a different type of financing called accounts receivable financing, purchase order financing, invoice financing, and all this other stuff. I don't even understand it. So I'll let Andrew talk about that. But one of the nice things about these programs is oftentimes they not only look at you, but they look at your clients or your customers. So Andrew.
Thank you very much. Again, my name is Andrew Crone, Marble Bridge Funding Group out in Walnut Creek. Again, we're a commercial finance company. We're private funders and not a bank. And we are lending directly to the small business community. In the 15 years we've been out here, we've probably lent near $1 billion for a small little company. That's pretty good. The clients that come to us, as I mentioned in the early part of my introduction, our clients are doing business with other businesses, but they're doing business with government agencies. So they're not doing business as a restaurant, a clothing store. Those stores are what we would call cash-based businesses. Can you hear me?
Speak up.
All right, I'm going to use this. Now you can hear me. All right. So these businesses are doing business with other businesses, or they're doing business with government agencies. We're not able to help the cash-based businesses. Some of the lenders here fit that, have that product, which is a better fit. But our businesses, when they do that type of business, they have to cut an invoice. So we're funding their receivables. So visualize this, you're a contractor, you're an engineer, you're an importer, you're selling the Safeway, you're selling the Whole Foods, you're providing software services, you're providing staffing services, some type of business model where you have to create a product, you have a product or you have a service, and you're billing that client, and that client isn't going to pay in 30 days, or they're supposed to pay in 30 days, but they pay in 60 days, they pay in 90 days, they pay in 120 days. You have people to pay. You have suppliers you have to pay. So you could be very successful on the sales end and generating growth in your business, but you can have a cash flow crunch. What we do is provide a solution to that. We're able to fund businesses within 24 to 48 hours of them needing that cash by taking those receivables and turning them into cash, Typical advance rates are 80%. So whether you're a contractor and you wait 90 days to get paid, or you're a small business where you need money in 30 days or less. So imagine you're doing $100,000 a month in your business. You have an opportunity, you take on a contract, and now you're going to do $200,000 a month in business. That extra $100,000 is going to take 60 days to pay. You're going to end up working for 30 days, then invoicing, then waiting 30 more days, and then waiting 30 more days after that. So you're saying, well, it's great, I got the deal, but I'm going to go out of business before I get paid on it. So that's where our industry, which worldwide is $1 trillion industry, it's sort of biblical in nature. It's been around for hundreds and hundreds of years. In the last 100 years, it's really evolved to be probably a next layer of financing under traditional bank financing. So whether, I've named a couple of different industries that are involved. How easy is it to get loans from us? Well, we've talked a little bit about the 5 C's of credit earlier today. We talked about, things that could be on your credit report. So some of the lenders here have a little bit lower standard, where you might have a bank and you're up here, and you might have a micro lender or an alternative lender, small business lender, like some of the people at the table here down here. I'm down on the floor, and I think most of you can walk over that bar that are in this room. Half the clients I see have been decimated from this collapse in the housing market. They have no equity, they've had to sell properties, their credit scores have taken a hit. My analysis, as Antonio was saying, our analysis is looking at your business. The real story is, how is the business performing? Is it growing? It could have had a loss last year. We could still fund you if we see a turnaround in play. So what we are looking for are businesses that are growing, and those are the businesses that seek us out. And they grow very, very quickly. I'm going to give you a couple of stories because I think this really puts sort of a personal touch to it. I have a client that I'm working with and I'm bringing in next week. We can get this funding done in 5 days. I'm probably the fastest lender in the group over here. So they get me what I need to get. I'm looking at financials. I'm understanding the business. We meet, we discuss. I underwrite it. I bring in. I'm the one who's going to present you and also work it through the system so you can get that funding. The client is a software company that's gone on the internet and is doing internet advertising. I know all of you go on the websites now and love watching ads. That's what they do. They develop websites that people go to, and then they see ads while they're looking at the content of the site. Imagine growing $7,000 in invoices one month, then you're getting $12,000, and then $24,000, and then $36,000, and $50,000. That's fantastic growth to these guys. The problem is they're not getting paid for 60 to 90 days. They want to build more websites. They got to turn that AR into cash. That's what we allow them to do. So that's a client that's coming in. I have another one who's working in the Bay Area. In 3 years has grown to $5 million. Their receivables right now are $2.6 million. They have partners with money, but those partners have a limit of how much money they have. They're not getting paid for 120 days from a major Fortune 500 corporation that has the money. And there's a long story behind it. They are getting paid. They've come to us for that cash so they can pay their bills, take on future contracts. So that's somewhat of what we do on that side. Another story, I'm going to leave you with one more story. We sometimes have clients who need more than receivable financing. They have a purchase order. We had a candy company in San Francisco, a $4 million company, does all their business, about 70% the last quarter of the year, the Christmas time. They got a Safeway order, and the Safeway order was for about $300,000, and they were maxed out with Ghirardelli Chocolate, their supplier. We gave them money ahead of the invoicing in order to complete the deal. And that order paid 15 days after they shipped the goods. They made 30% on that $300,000 order. Without us, they would have walked away from it. I'd love to talk to you later. There's a lot more to learn about it, but I appreciate your time and welcome.
All right. Thank you, Andrew. I just learned a new technique. I think I got to sit next to every single panelist so they stop right on time. Actually, the first one that actually applied that clock there. Thank you very much, Andrew. Andrew, I like how Andrew presented that, and I will tell you why. Oftentimes when we talk about alternative source of financing, especially AR, PO financing and stuff, and those type of products, we always focus, and I'm guilty of this, I always focus on the negative. I always say, well, you can't qualify through a bank, we might want to go here as an alternative. He approached it from something, a completely different place, and it's something that I usually talk about in terms of growth. And one of the killers of small business is too much growth or growing too quickly. Why? Because you can't finance that growth. And sometimes your bank or your lender may not be prepared to grow that quickly with you. So that can be a killer in the business too. I always say take small steps. I always say grow proportionally, grow slow. But if you're in a business and you're experiencing rapid growth, this is a great resource for you guys. So always consider that. So thank you, Andrew, for pushing for that standpoint, because we always focus on, well, if you can't qualify here, go there. You can't qualify, go there. No. If you're doing well, and you just can't finance that growth, know that you have other resources. Okay. Last but certainly not least, we have Anthony, my namesake, here to talk to you about, among other things, something called crowdfunding. It's something that's still very new to me, but it's been getting a lot of popularity, a lot of attention lately. And Anthony, take it away.
Sure, thank you. Let me tell you about crowdfunding. Crowdfunding is a brand new technique for raising capital. I'll give you the definition straight from the National Crowdfunding Association. A way to raise small amounts of money from large numbers of people online for a specific project. And it's related to, in fact, it builds on the success of two concepts that have been viable for quite some time: microfinance and peer-to-peer lending. Microfinance is different from crowdfunding because it's institutionally based. Think back to 2006, the Nobel Peace Prize for that year went to Grameen Bank of Bangladesh, which is an institution that originates microloans for micro-entrepreneurs in Southeast Asia. Crowdfunding is related to that, but it doesn't rely on an institution's pool of capital. It relies on collective pool of capital from many individuals. And also with peer-to-peer lending, that was a concept that originated a few years ago, where one person can loan to another person with no financial institution as an intermediary, doing it online with third-party credit checks and defined a fixed interest cost of capital. I think a crowdfunding platform, and some platforms are certainly going in this direction, that incorporate both of those traditions into their platform, their portal offerings, will be very successful and make a potential very attractive acquisition target if any of these big broker-dealers like Goldman Sachs ever want to buy a crowdfunding portal. Now, why is crowdfunding suddenly now viable? Well, in April of this year, the President signed into law the Jumpstart Our Business Startups Act, JOBS Act. The JOBS Act, 22 pages of really a fairly easy read, redefines what it means for investors to invest in small companies. Specifically, it exempts young companies from certain financial reporting requirements like Sarbanes-Oxley, and registration requirements for their securities if they adhere to the category of an emerging growth company. Most significant rule for being an emerging growth company in the eyes of the federal government is to have gross revenue of less than $1 million per year. And the SEC is developing other rules and regulations to implement the JOBS Act and define what it means to be a viable company, what it means to be a type of investor for this type of company. So if you define yourself as an emerging growth company, what do you do to raise money through crowdfunding? Well, there are many portals that have sprung up. The SEC is tracking about 1,600 online portals, not all of which will be viable over the long term, that claim to be crowdfunding portals, but only 8 of them are registered with the SEC. That's another legal requirement. The portal you use to be viable under the JOBS Act and exempt from these regulations must be one of the handful that are getting registered with the Securities and Exchange Commission. So how do you do this? There's potential for fraud in this sector. It's brand new. It's like the Wild West. What eBay and PayPal were to e-commerce in the 90s, this sector now is in our time. It's brand new. There's potential for abuse. How do you stay safe? How do you avoid lawsuits? How do you stay out of trouble? Let me propose 4 best practices that entrepreneurs can use to stay clear of trouble in crowdfunding. Number 1, post your business plan online. Whatever portals you use the standard techniques of a business plan. Have an executive summary, 1 to 2 pages. Have your slideshow in PowerPoint or translated to PDF that tells how you're going to get from A to B and solve a market problem, and your financial projections, 2 years worth of cash flow estimates, how you're going to get profitable. Post those online so everybody who uses a portal can see what you're all about. Best practice number 2, have a prospectus. Get an attorney. Don't do this yourself unless you have experience in securities litigation or business valuation, to write an offering memorandum that will describe the risk factors and some of the other negative, dirty laundry aspects of your business that investors have to see, because eventually we don't know how the SEC is going to interpret what rules they're going to publish years from now to implement the JOBS Act. Be as safe as possible. Have a prospectus online that your potential investors can review. Best practice number 3, have a term sheet. The term sheet is a document that you or your attorney or accountant or whoever generates to describe the capital structure of your company and what your investor gets when they give you money. The good news is there are major law firms like Nixon Peabody and Orrick and I believe Wilson Sonsini also that have automated term sheet generators as a free public service to entrepreneurs on their website.
So go to the site of a major law firm that serves the business community, look at what their entrepreneur self-help center looks like, and see if you can do a self-generated term sheet. Term sheet will describe your capital structure, the par value of whatever shares you're selling, whether they're common stock, preferred stock, convertible loan, whatever. That's something you should also post publicly. The Jobs Act allows you to do these type of things now. And the fourth best practice I'll recommend is a social media campaign. If you build it, they won't come, to paraphrase Field of Dreams. No matter how many funding portals you use and how robust they are and how many different services they offer, it doesn't make sense to do that unless you have a good social media campaign, which you can do now, thanks to the Jobs Act, to advertise and publicize the fact that your business exists and that you're trying to raise money. And that's how you can be successful. Or you can increase your chances of success and minimize your chances of getting sued. That's it.
That's a great closing. Minimize chance of getting sued. Thank you very much, Anthony. Sir, I want to make sure you're able to get to the side, right? You're good there? Don't see right here. So now we'll open it up for Q&A. Please keep in mind that you have two larger bank partners here, as well as a community bank and non-bank partner, alternative lender, and some crowdfunding. So we have a wealth of information here. Now, I always get worried when I go into the Q&A session, so I'm going to try and, before I put down this time, limit each of you to one question per hand raise, okay? And there's no such thing as two-part questions. There's no such thing as sub-questions to your question. You know, just in all fairness, try to squeeze in as many questions as possible. And also, I'm going to limit my panelists to answering one panelist per question, if possible. So with that, wink, wink, do a little thing, and I'll catch you. Okay, so let's start right here.
That was a great story you just told. I loved it. I feel like the ending was left off. So what do you do?
I'm a blogger. I don't crowdfund at all. I don't have a portal. My portal is on pdcapital.com. I just publish news, analysis, commentary, and humor.
You're just information.
I'm just information, that's all.
Awesome. Thank you. Yes, ma'am.
You said the first thing to post was your business plan online?
Yes.
And then I used the second one, I got financial protection.
Can you repeat the question?
Yes, I'll repeat the question, yes. Your question was to Mr. Anthony, that the first step was to post your business online. What were the next 2 or 3 steps?
4 total. Number 1, business plan. Number 2, prospectus, also known as offering memorandum. Number 3, term sheet. And number 4, we won't post this, but you'll be executing this on a daily basis, social media campaign.
Is that on your website?
Yes, I wrote an article just last night talking about some
Oh,
of
he
this
snuck that question in real quick. Look at that.
You'll see some of it, and I'll post some more tonight. I'll discuss this.
He didn't raise his hand. Look at that. He just snuck it right in there. Yes, ma'am. Yes, Richard.
Even though we're not in a utopian society quite yet, and business looking for a loan, what are the criteria that is most impressive to the banking institution? Is it capacity cash flow versus collateral? Are there grades that you look at that might be more impressive than others? And can you share those with us?
That's a great question. Did we all catch that? What is the criteria and what do the bankers will put more weight on in terms of receipt of credit?
Yeah, I can take that question. Number one, you hit it. The most important facet of all credit analyses is capacity. So do you have the ability to service the debt, right? And how we look at that is historically. So we're looking at all the debt that you have, business and personal now, and the proposed loan, and we see, would you be able to pay that over the last 2 years of the income based on your tax returns, right? So that's number one. I'd say number 2 is definitely collateral. That's that's usually what keeps people, everyone knows this right now, property values are down, right? So when you're given a real estate loan, your collateral is property. So that can keep the loan from going forward or not. With lines of credit, same thing. We're collateralizing on accounts receivable. So the banks will look into that and they'll say, okay, here are these ARs that we're funding. Who are those customers and how quickly are they paying? So let's say you have a business and there's a very concentrated amount of business. Let's say 25% of your business comes from one client. right? The bank is going to be a little more weary as opposed to 25% of your business comes from 5 clients, right? So I would say cash flow number 1, collateral number 2, and then definitely for operating companies would be liquidity. The banks want to see that you have 6 months of reserves in unused, untouched funds to service all of the business's debts.
Thank you very much. So in other words, it's all in one. Yeah, that was it. Got it. Thank you. No, that was very good, actually. Sir, you had a question? Then I got you. You're good? Sir?
I'm interested in knowing the timeline that you use for startup businesses. Is it from 0 to 2 years or 2 years and older?
What is considered a timeline for a small business, quote unquote?
A startup, I'm sorry.
Startup business.
I'm sorry.
Anyway, Wells Fargo?
Wells Fargo, 0 to 1
Okay.
would be my criteria for a startup. After 1 year with a filed tax return with the government, for me, you're in an expansion at that point in time.
And just to add to that, most lenders will probably still consider you, in that 2-year window, just in case that first year's in a full year of taxes. We may say, okay, well, we want to see that 1 full year. So you might be in business 1.5 years, but we want to see that full year of tax returns, just to get a good gauge of what 1 year looks like. So thank you for that. Ma'am?
What will be the upfront fee for like SBA loan to purchase the property? So how much will it cost for the appraisal? Do we need to do the environmental report, and what will be the time frame for us to acquire?
Man, that was like 5 questions, but I'm gonna slide. I'm gonna slide because that was a good set of questions. That was amazing. You just tricked me. You didn't say like sub-questions, 3-part questions. Anyway,
Okay, I can handle this. The environmental fee and the appraisal is not, I cannot give you a number on. Commercial appraisals are put on a board to be bid on by an appraiser, and it is our policy to take the most reasonable bid when that is done for you. Environmentals work the same way, so I can't give you an exact answer or even a range.
I can give you a ballpark. So for a commercial appraisal, you're looking at $2,000 to $4,000, and I would say for an environmental report of phase 1, that could be as much as $5,000.
So is this a must for the environmental?
Well, any loan, SBA loan, yes, I would say so, but
No.
not for 7. Under $1 million for a conventional loan, you do not need environmental. So you can speak on SBA.
No, you can order what's referred to as an RSRA, which is an opinion of someone. And what they do is they pull reports to see if there has been any environmental issue done, or if the property has had an environmental issue, and then we would order the phase 1. If the property comes back clean, there is no reason to have that. And for SBA fees, ma'am, it's an amalgam. It's basically 3% of 75% of the loan amount over $150,000. Under $150,000, it's 2% of 85% of the loan amount. And then there's some other layers in there again. So that's just your ballpark figure.
thank you very much, ma'am.
Okay.
We'll talk to that. All right. Thank you very much. Great questions. Sir?
Offer special tax benefits for cable tax exemption.
It's a beautiful question. Have you heard that?
Or lower the value of how much, lower the barrier to entry.
Now you're answering your own question. I think the gist of the question was, do any of these lenders here today do loans in enterprise or empowerment zones? Anybody?
We certainly do loans in, I have several clients that are working in special areas like that. I think the key savings usually for a company come in terms of getting tax credits for the owners. After they've gotten profitable, they can usually get some money back on their tax return because of hiring people in that zone. None of our pricing, except what's required through the SBA regulations, is set in stone. We have guidelines, and then we negotiate every deal specifically in terms of pricing. at my bank, which is, may not be the same as others.
Thank you very much. Sir?
Daniel and Ryan mentioned, this question sorry is directed at you, Andrew. Daniel and Ryan mentioned comparisons to conventional of the SBA where fees are involved. Okay. Are there percentage fees involved where you are giving loans on receivables?
Let me repeat the question, Andrew. The question is for Andrew. The two bankers obviously mentioned that there are fees involved in any kind of traditional loan process. The question is, are there any fees and what are they when it comes to accounts receivable or personal finance?
So on my type of business model, there's generally 3 fees, pretty simple. We have a one-time application fee, which from my perspective, I don't ask for it until I've seen everything. So we've gone over financials, numbers. I've taught you the business model, so you understand it. I understand your business, so we're getting close on that end. We both see it makes sense, and then you get a one-time app. The app fee depends on the volume of the business, but it'll be between $300 and $600. That's number one. Number 2, the second fee is the way we charge fees. It's on the individual invoices. So you may have 100 invoices, you only fund one. The fee is on that one invoice, and think of it as a discount off the face value of that invoice. Could be 1 to 2%, or it could be more. It's time related. So the faster the invoice pays, the lower the cost, the longer it takes to pay a higher cost. We've already covered that. And the final thing is when we send you the money for the invoices that you want, the fund, we wire it to your bank account. So there's a wire fee, small wire. That's it.
Thank you very much. Sir?
Yes, Anthony, with crowdfunding, geographically, can overseas people or out of state, what are the laws about that? Who can participate?
Out of state, certainly. Overseas, I'm not sure. I'm going to wait for the SEC to implement rules on that. Looks like they're going to publish their first set of rules by February next year. Out of state, not a problem. It's like using a broker online. Foreign countries, I don't know. I know Australia has had crowdfunding applications for at least 7 years. Great Britain has had them for at least 2 years without any difficulty. I don't know if an American subscribed to an investment offered by a platform in one of those countries. I don't think it's been tried yet.
Thank you very much. Sir?
Yeah, for Catherine. Can a company open a domestic line of credit, letter of credit, I should say, with your bank?
The question is for Catherine. Are a business available to apply for get a letter of credit?
Domestic.
Domestic. So you're talking about a documentary letter of credit for import?
No. Domestic. Instead of a international.
So maybe for like a lease or something. You need it for a lease.
You mean like a standby letter of credit? What, yeah, for a lease? What is the purpose of the letter of credit? What's it doing for the company?
Basically, it's the same purpose why a letter of credit is open, except that this is now done domestically.
With a domestic receivable transaction is what you mean?
Yes.
Yes, that can be done. My bank does not do documentary letters of credit. We don't have an international group, but I know Wells and US Bank and many of the Chinese banks and Asian banks in the area do documentary letters of credit. We do standby letters of credit all the time, and standbys are generally used as a deposit for a lease or in lieu of a guarantee, something like that. And they generally are never called, in other words, never funded unless there's a problem, whereas a documentary letter of credit would have a turnover and always be funded.
Thank you very much. Sir?
Thank you. I wonder, the crowdfunding that the gentleman described is supposedly going to be openly available supposedly by February or March next year, but right now there are entrepreneurs raising funds from relatively strangers, ordinary investors through DPOs or community financing supportive methods like advanced sales. So I would wonder if you can comment on those.
I don't know anything about DPOs or advanced sales, not my area of expertise. I do know that, yes, you are correct. Entrepreneurs are raising equity capital right now from several sources in the hopes that those sources won't be shut down when the SEC starts to implement rules next year. They may very well be grandfathered in if the SEC just decides to be lazy and not pursue anything that may violate a rule formulated in a post hoc fashion. But right now it's like Wild West. Anybody can get in on it.
Thank you very much. Sir?
Andrew, do you guys help out with collections at Factor AR with you or not?
On the collection side, the way we handle it, there's two ways to do it. So if our client has a relationship with their clients, and it's a very close relationship, they're welcome to do it. It doesn't cost us anything. A lot of our clients have us do it, and it doesn't charge anything. It's part of what you're paying for in the fee. We had a client last year who wasn't getting paid by a major supermarket in town that had several million out, and we paid. Excuse me, sir. I'm gonna ask that one again. You want to repeat the question? I don't think you did. You repeat it. Okay. The question was, do we help out with collections? And so part of what you're paying for, there's more than just funding on our side. There's service, and there's also some advice in running a business and stuff that we can add as value added. But some of our clients have a relationship with their client, and they want to do the collections on those receivables. It's fine with us because it doesn't cost us anything to do it, and so that's fine. But some of them want us to help. We had a client last year where they had several million out with a major supermarket, and they weren't getting the money in fast enough, and they were too overwhelmed with the business for their people in accounting to take care of it. We got involved a week later. We helped them get $1 million. It's very soft in approach. It's just communicating. That's all it's about.
Thank you very much, ma'am.
Hi, this question is for either Nick or Anthony. I'm not, it's for a startup, and I'm a little confused as to whether it's best to go through an investor or through an organization like yours to get the initial startup.
The question is, getting investment capital or going to a lender. Lynn?
In regards to the investment part, what you probably want to be aware of is the percentage of ownership that they would be taking if you're going through the investor and coming through VEDC or another alternative lender. It would just, what we would require is at least 30% down for startups. So 30% for whatever the cost to start up your business.
Any question right there?
Another question is probably more like an answer for the product team. Is if there is a law firm in Berkeley that specializes just in that area, so if someone needs that information, I'll be glad to.
Okay. You're saying the question with crowdfunding, there's a law firm in the Bay Area that can help with that. Sir, question?
My question has to do with animal as a whole.
Not me. Just say that.
You know, stand-up comedy nation. If I'm seeking out a team, as you eloquently said, how would I utilize an angel over there with what they do? So where should I go? This is 3 years. I'll need expansion funding. Should I go toward an angel and try to pursue what their criteria is versus theirs? What's the path of least resistance that they recommend?
Well, for me to answer that, so that's 6 questions right there. So, but if you repeat the question more eloquently than I can.
If you're asking when is it fortuitous to use an angel investor as part of your pitch, as part of your capital raising project, I would say angel investing could come as the next step after crowdfunding. Crowdfunding can come
after you exhausted the friends and family route and dug all the change out of your couch and whatnot. Angel investing is certainly the next step. It's a bridge between what you funded on your own through your own personal network and what you would have to fund from strangers through venture capital or through bank loans.
Somebody else want to say? Sure.
Yeah, I would say try to get a loan from a bank first in case you can qualify, maybe under the SBA program, because you don't have to give up any ownership, you don't have to give up a board seat, you don't have to give up any control. And this is pretty miraculous financing with limited capital but some cash flow. Often you can get the expansion capital. I do work with many clients who have multiple sources of funding, be it angel investors, friends and family, and then the bank provides a piece of that puzzle.
Anybody else want to say? Okay, we have time for 2 more questions. Sir?
How long does it usually take to get a loan for a new business? What's the average time?
Average time it takes to get a loan for a new business, if they can get it.
Okay, so through VEDC, our goal is from the time that we receive complete package, and the definition of complete package is all the financial information, your business plan, your personal tax returns, et cetera, et cetera. Our goal is to be able to close and fund the loan within 45 days. So that's from complete package to closing.
I'd say that it's probably pretty similar amongst all of us here. The caveat to that is, assuming we have a complete package. Oftentimes, and I'm sure I'm speaking for most of my members here, oftentimes what delays the process is not having a complete package. So keep that in mind. 2 more questions. Ma'am.
I don't want to use the word disruptive, but technology that is so new that it's not been in a business before.
How do banks treat quote unquote unproven technology?
I as an SBA lender I can do a loan to, or we can make a loan to you, but we're gonna go back to those C's that we talked about, and there is gonna be, we would call it a startup. You would need to have down payment, and what's most important is we probably want some collateral from you to secure the loan, and that collateral is not going to be your patent, your future technology, or anything like that. We want your home equity, if you have any, pledgeable stock or cash, because that is what we're gonna look at, because this is a very risky loan for us to make for unproven technology. So we're going to strive to be fully secure with your collateral.
Yeah, and to that question too, I think in that case, making the connection in a business plan between the technology and the cash flows that the technology will produce. I think if you can show the logic behind what your projections are and a business model, how that's going to be brought to market, what your operating cycle will be, and putting actual projections together would be your best way to communicate that concept to a bank.
Great, thank you very much. Well, last question, sir.
This question is for Lynn, and you mentioned that you guys look at 3 things: credit, collateral, and cash flow in order to determine, approving a loan. And if 2 are out, like 2 strikes out of 3, what is, because obviously for some, I don't know if that's the case for a lot of business owners, but some businesses are bootstrapped and there's no collateral, so in terms of credit, it's usually tapped out. So
usually if there's 2 of the 3 that are missing, what we'll do is we'll come back with you with some solutions. Can you go back, and if you're missing collateral, is there family member out there who's willing to use their house as collateral to support the credit? We do a lot of funding that way, where the parents, the grandparents, friends, somebody will use their house as collateral. So then there's just the 1 C that's missing, and then we're able to proceed.
I think one blanket answer, if I can just add to what most of our analysts have said, is as lenders, for the most part, we're always thinking exit strategy. If I have to exit this credit facility, this loan, what's my strategy? And oftentimes, when you're going to have like a captain, let's say, go to a credit committee and fight for your loan, and it's one of those loans that's kind of in the gray area, oftentimes that is going to push it over, because they're going to ask the question, what's our exit strategy in this loan? And there begs the question to you to ask yourself to say, okay, how do I mitigate this risk? I don't have cash flow. How do I mitigate this before I even go talk to Lynn or talk to Catherine or any one of these guys? I have a weakness. I know what it is. How do I mitigate that? Okay, so always think that way. Anyway, we're out of time. Please help me thank our panelists today. Thank you very much.
Bravo.